Listen to me very carefully. You have been lied to by omission. For decades, financial gurus, Wall Street planners, and HR departments have programmed you to believe that the HSA, the health savings account, is the ultimate untouchable holy grail. But what if I told you they're dead wrong? They tell you to max it out, never touch it, and let that sweet, sweet compound interest ride into the sunset. And look, let me be real with you, they are absolutely right. Until the exact day you turn 65, and that's when the trap violently snaps shut. After 65, if you cross one specific, almost invisible tripwire built deep into the IRS tax code, this exact account turns into a financial parasite. I am talking about a legally enforced compounding penalty eating your money. Sounds like a bad movie plot, right? I wish I was exaggerating. Today, I'm going to walk you through a systemic trap that is currently wiping out the Social Security checks of thousands of American retirees. This isn't a glitch in the matrix. The system is designed to hunt you exactly like this. By the end of this masterclass, you are going to understand the exact legal mechanism the IRS uses to track this. You'll see the terrifying chain reaction it triggers across your Medicare and your Social Security. We'll get to the absolute craziest part in a second. But most importantly, I'm going to give you the exact step-by-step sequence you must follow to bulletproof your net worth. I'm the director of this channel, and we don't do surface-level cookie-cutter advice here. We dissect the financial matrix. So grab a pen, because your retirement depends on this. Let's talk about the so-called triple tax-free myth. You put money in tax-free, it grows tax-free, and you pull it out tax-free for medical expenses. It sounds like the ultimate cheat code to American wealth, doesn't it? But every cheat code has a hidden penalty flag. Wall Street loves selling you the dream. They want your capital locked up, generating fees for them. They hand you the keys to a Ferrari, but conveniently forget to tell you the brakes are rigged to fail. And you won't realize it until you're already crashing. To understand how this predator operates, you need to see exactly how it hunts in the wild. Let's strip away the theory and look at a real-world scenario. Let's call our protagonist Eleanor. She's just like you. Actually, she might even be better with her money. Eleanor is 68 years old. She's smart, she's highly responsible, and she decided she wasn't quite ready to retire at 65. She kept working at her high-level corporate job and stayed on her employer's high-deductible health plan. Makes total sense so far, doesn't it? Because she's a diligent saver who listens to all the top finance podcasts, she continued maxing out her HSA. We're talking over $8,000 a year, plus the catch-up contribution. She's doing everything completely by the book, or at least the book she was allowed to read. She's feeling fantastic. She's got a massive nest egg. Finally, at 68, she decides it's time to pull the trigger and coast into the good life. She boots up her laptop, logs onto the official Social Security website. You can probably guess what she clicks next. She applies for her retirement benefits. She clicks Submit, closes the laptop, and pours herself a nice, expensive glass of Cabernet. She assumes she just permanently secured her golden years, locking in that sweet monthly government check. Here is the brutal, heartbreaking reality. She didn't secure anything. With that single innocent click of her mouse, Eleanor didn't just claim her pension. She accidentally armed a financial time bomb that was hardwired directly to her net worth. And it's ticking, but the explosion doesn't happen right away. Oh no, the IRS is way more patient than that. The bomb she just armed is set to detonate exactly 2 years later, completely annihilating her monthly cash flow. She committed what tax attorneys quietly call a fatal sequencing error. Ever heard of the term retroactive entrapment? Probably not, because no HR rep is ever going to put that on a PowerPoint slide during open enrollment. It's a quiet, ruthless trap. And Eleanor didn't even know she was bleeding out until the federal letters arrived. Let me break down exactly how she got framed. Imagine driving down the highway following the speed limit, and suddenly a cop pulls you over and hands you a massive ticket. Not for speeding today, but because they secretly changed the speed limit 6 months ago. And they are charging you for every single mile since. That is exactly what happened to Eleanor's money. She thought she was building a fortress, but the government viewed her actions as a massive, illegal tax evasion scheme. And they have the legal authority to crush her. You're probably thinking, how is that even legal? That's the beauty of the American tax code. It doesn't care about your feelings, and it doesn't care about your intentions. It operates on cold, hard, mechanical tripwires. When Eleanor crossed that line, she triggered an absolute avalanche, and nobody, not even her boss, warned her. Let's strip away the emotion for a second and look at the cold, hard federal law. We are going to break down the first domino in this disastrous chain reaction. Under Internal Revenue Code Section 223, the law is black and white. There is absolutely zero gray area here. The rule states that the exact moment you are enrolled in Medicare, you instantly lose your legal eligibility to contribute a single dime to an HSA. Zero. Nothing. You are locked out. But here is the massive, gaping trap. And it is a vicious, unforgiving one. Think about our girl Eleanor. She didn't apply for Medicare, right? She specifically applied for Social Security. But what the government intentionally buries deep in the fine print is a forced enrollment clause. When you apply for Social Security after age 65, the government takes away your choice entirely. You are automatically and mandatorily enrolled in Medicare Part A. You cannot decline it. You cannot opt out. If you want your Social Security check, you are taking Medicare Part A whether you like it or not. But hold on, because it actually gets so much worse. By federal law, your Medicare Part enrollment is not applied on the day you click Submit. Oh no, the government applies it retroactively for up to 6 full months. Let that sink in for a second. Let's do the math on how this destroyed Eleanor. Think about the timeline here. Eleanor applies for her retirement benefits in November. The government automatically backdates her mandatory Medicare coverage all the way back to May. But what was Eleanor doing from May to November? She was doing exactly what the gurus told her. She was still working, still on her corporate health plan, and actively funneling thousands of dollars into her HSA. But because of that sneaky 6-month retroactive date, the matrix just flipped on her without warning. Those contributions are no longer a smart investment. Because her Medicare was quietly backdated, all those HSA contributions for those 6 months instantly become illegal in the eyes of the IRS. They are immediately reclassified under the tax code as excess contributions, and the IRS does not take excess contributions lightly. This brings us to the penalty phase. Enter IRS, Form 5329. The IRS slaps a 6% excise tax penalty on every single dollar of that excess money. And here is the absolute most brutal part of this entire scenario. Are you sitting down for this? It is not a one-time slap on the wrist. It is not a flat fee. It is 6% per year, compounding continuously for every single year that illegal money sits inside the account. It is a bleeding financial wound that simply does not clot. If you don't catch it, and remember, the government isn't going to send you a friendly text message about it, that 6% penalty eats away at your capital year after year after year. It drains the account from the inside out. You're literally paying a tax on money you thought was tax-free. The irony is just sickening, isn't it? The very account designed to shield you from taxes is now the exact vehicle the IRS is using to bleed you dry. But honestly, the 6% penalty is just a paper cut. We haven't even reached the actual slaughter yet. Now look, if this was just a 6% tax, it would be a massive headache. You'd pay it, you'd probably swear at your accountant, and you'd move on with your life. But this is a masterclass. And I promised you a full-blown chain reaction. Welcome to the slaughter. A year later, Eleanor sits down with her CPA to do her taxes. He looks at her paperwork. His face drops, and he catches the retroactive mistake. He breaks the bad news. She owes thousands in back penalties to the IRS. To stop the bleeding, she needs to pull the excess money out immediately. But between paying the IRS, amending her past tax returns, and covering the compounding penalties, Eleanor starts to panic. She desperately needs a chunk of cash. So she does exactly what millions of Americans do. When people need cash fast, they look at their biggest pile of money. She logs into her pre-tax traditional 401k and rips out $40,000 in a lump sum. She pays the IRS off. She breathes a heavy sigh of relief. She actually thinks the nightmare is finally over. It's not over. It's just mutating. Fast forward 2 years. Eleanor, 70 years old now. She walks to her mailbox, opens a letter from the Social Security Administration, and her heart just stops completely. Her Medicare premiums haven't just gone up a little. They have completely exploded. Why? Because she just fell victim to a stealth wealth tax called IRMAA. That stands for the Income-Related Monthly Adjustment Amount. If you haven't heard of it, it is the silent killer of retiree wealth. Let me paint a picture of how ruthless this is. Instead of throwing a confusing, microscopic IRS spreadsheet on the screen, just imagine a series of tripwires. The government looks at your modified adjusted gross income, your MAGI. But they don't look at what you are making right now. They look back in time, exactly 2 years ago. The system has built-in invisible income brackets, and these aren't gentle slopes where you pay a little more. If you cross one of these brackets by literally one single solitary dollar, your Medicare premiums skyrocket. They double, triple, or even quadruple for an entire year. There is no phase-in. There is no grace period to fix it. It is a sheer vertical cliff. So when Eleanor panicked and pulled that 40 grand from her 401k to fix the HSA mistake, what happened? It artificially spiked her MAGI into the stratosphere. It violently shoved her right over the IRMAA cliff. She triggered a massive wealth penalty just by trying to pay off a different penalty. It's like stepping on a landmine while you're running away from a bear. And how does the government collect those skyrocketed premiums? They don't send you a polite bill in the mail. They don't ask for a credit card. They deduct it directly, automatically, and mercilessly from your monthly Social Security check before you even see a dime of it. Let this absolute tragedy sink in for a moment. Because she didn't know about a hidden 6-month retroactive rule on her HSA, she was forced to raid her retirement account, which spiked her income, which triggered massive IRMAA surcharges, which ultimately cannibalized her Social Security. The check she thought she secured is effectively gone. The very safety net she worked 40 years to build was eaten alive by a cascading series of automated government tripwires. This is the domino effect in action, playing out right before your eyes. This is exactly what Wall Street fails to warn you about. They manage your wealth, sure, but they don't manage your tax sequence. They leave you totally exposed to the IRS crossfire. And the craziest part? Every single step of Eleanor's destruction was 100% legal. But you aren't going to end up like Eleanor. You are watching this because you want solutions, not just horror stories. So let's pivot away from the disaster and get straight to the master rescue plan. If you are approaching 65 or working past it, listen up. Here is the exact sequence of operations. And I must heavily emphasize the word sequence. In tax law, doing the right things in the wrong order is still totally illegal. Quick disclaimer before we get into the weeds here. I am a strategic educator, not your personal fiduciary. Do not just wing this. Take these exact steps to your CPA and force them to execute it. Step 1, the 6-month severance. This is where you stop the bleeding before it starts. If you plan to claim Social Security after age 65, you must completely stop funding your HSA, not the month of. Exactly 6 months before the month you submit your application. Shut it down entirely and inform your HR department immediately. Step 2, the surgical extraction. If you are watching this right now and realize you've already fallen into the trap, do not panic, but act fast. Before your tax filing deadline, you must contact your HSA custodian directly. Do not just transfer the money out yourself. If you do that, you trigger an entirely new set of audits. You must request a specific documented transaction called an excess contribution removal. Why is the exact wording so incredibly important? Because by law, you must remove the principal and the profit. They call it the net income attributable, or NIA. The bank has to calculate exactly how much profit those illegal contributions made, and they have to rip that out too, down to the penny. Step 3, filing the defense. Your CPA must correctly file Form 5329 to report the excess and Form 8889 to reconcile the HSA. Do not skip this paperwork. If you do, that 6% penalty clock just keeps ticking in the background. Step 4, breaking the chain reaction. Here is the absolute most critical piece of advice in this entire video. If you need cash to fix this mess, listen to me very closely. Never ever pull it from a pre-tax 401k or traditional IRA. It will spike your MAGI and trigger the exact IRMAA slaughter we just talked about. Instead, you need invisible money. Draw from a Roth IRA, which does not count toward your MAGI, or use a HELOC, or sell taxable stock sitting at a loss. Use aggressive tax loss harvesting to generate the cash. And don't think you can just fill out Form SSA 44 to beg the government for mercy. It literally does not work like that. Form SSA 44 is incredibly strict about what it actually forgives. It allows you to appeal an IRMAA surcharge if you had a life-changing event like marriage, divorce, or a complete work stoppage. Guess what? Screwing up your taxes is not a recognized life-changing event. The government will reject your appeal instantly and laugh while they do it. You must prevent the MAGI spike in the first place. You have to cut off the oxygen before the fire even starts. Here is the systemic truth you need to accept today. The American tax code is not designed to protect you. It is a cold, mechanical filter designed to assume you are omniscient, and it penalizes you without mercy when you prove you aren't. They won't text you a friendly warning when you hit 65. They will just wait quietly for you to make a sequencing error. And then they will legally harvest your wealth through 6% penalties and IRMAA surcharges. But now you have the blueprint. You can see the tripwires in the matrix. So here's what I need you to do right now. If you found this level of deep dive breakdown valuable, hit the subscribe button. But more importantly, think of one person in your life who is approaching retirement or who prides themselves on maxing out their HSA. Send this exact video to them immediately. You could literally be saving them hundreds of thousands of dollars and rescuing their Social Security checks from being swallowed whole. Stay vigilant. Guard your wealth. I'll see you in the next masterclass.